Justin Worden, the marketing coordinator for the Federation of Credit, and we're here with Ken Frisco, who is the operating board director, as well as Rich Hastings of Seaport Global Securities, and he'll be doing today's presentation on the big themes and the U.S. holiday 2015 outlook. A couple of brief items to get out of the way before we begin. If anyone has any questions throughout the presentation, you can feel free to put those into the questions function, and we'll save those all for the end of the presentation. Also, we do have a brief survey that will go out at the end once you close the webinar. It gives us a lot of great insight into how we can continue to make these presentations better for you. So with that, I'm going to pass it over to Ken and let him do an introduction of Rich.
Okay, thanks, Justin. Our presenter, Rich Hastings, serves as the macro strategist for international investment bank Seaport Global Securities, formerly Global Hunter Securities, where he monitors a wide range of data trends and major drivers of the domestic and international economies. Richard is well known for his warnings in 2006 and 2007 regarding the housing market and subsequent financial crisis, and later for his early call during December 2008 that the market was oversold and would enter a major bullish reversal starting in early 2009. Richard previously was a commercial credit professional and holds a certified credit executive designation with the National Association of Credit Management. So I'd like to pass it to Rich to start the presentation.
Thank you, Ken. Let's make sure that everything is working. So let's double check on all the technology stuff. Ken and Justin, how does this sound in terms of voice volume? Is this okay?
Sounds good. We can see your screen. Everything's great.
All right. And this will be just a transition to the next screen. And did that go okay?
Yes.
Beautiful. Then let's move right along. Big themes. One of the biggest is people on the move. This is not only an international thing. This is everywhere. It's in the United States. And, you know, it's really going to change the nature of what type of consumer is in what market in the United States compared to the previous paradigm of what kind of consumers and what income brackets and what demographics were in what markets. So many people are on the move, and the migrations in the United States, it's turning into a really, really big story in so many cases because of the ability to connect remotely, and the comfort level with working that way is now expanding into so many different kinds of professions that it's really facilitating migrations into places that never had the jobs to support these kinds of new inhabitants and immigrants from other states. Boise, Idaho is an example from the case of California, with some people leaving California because of unaffordability. And it's not like Boise, Idaho has the jobs to support all the people who are moving there. In so many instances, they're able to work remotely. And this is expanding all over the country. It's a big, big deal. And then, of course, in Europe, there's the refugee side of it, which is comparable in a different way. And then we'll tie all that together, and we'll see how it all fits together. And there does seem to be a common theme between some of what's going on there and the consumer story here in the United States. With that being said, let's start off with a good pulse of the mood of the consumer in the U.S. Surveys of more than 6,000 shoppers a month by Prosper Analytics result in the following on slide number 4. The blue line is those who are very confident about prospects for a strong economy. And what we're looking for in something like this is, have we achieved the peak? What's the momentum going into things, for a better attitude? And are we past the best point of their attitude and confidence? And clearly the trend shows that the consumer mood has peaked in recent months. And while things are reasonably good, the best of that mood has come and gone probably about 3 and 4 months ago. And now we're starting to see that there's a little bit more concern about many different things. And to try to figure out what makes the consumer really tick, there are so many different things that influence it. cost of connectivity, obviously bills for, wireless, internet, digital phone, cable packages of any type, or, a wirelessly delivered satellite TV package. These are enormous bills, and they tend not to go down. They tend to creep up year after year. Cost of education, psychological impact from student loans on many people weighs upon them, even when they're not in the repayment cycle. The wage stagnation, of course, weighs upon people over time. So if your bills for connectivity slowly creep up, even by 3 or 4%, let's say in 1 year, and wage growth is only averaging 2% year over year, after a while, after 4 or 5 years of that, the whole consumer economy cycle starts to slow down. And it's things like that that are adding up. We noticed from the last government set of numbers on job creation that the job creation machine is still creating new jobs. A lot of them don't pay what we would like to see, but we're seeing a slowdown in job creation, and people can feel that also. So while we're not seeing any kind of an increase in claims for unemployment benefits, and that would really creep up if people started to get dismissed from a position and then could not quickly find another job. Then you'd see people starting to file for unemployment, jobless claims, and that would show up in weekly jobless claims. And those numbers are very low. There's a pretty good flow among those who are losing a job in something, and they're able to find something else. But the wage flow, that might not be as encouraging. But clearly, when we look at slide number 4, when your orange line starts to creep up and your blue line starts to creep down, that clearly means that your cycle has peaked, and now things are very, very slowly beginning to slow down. We're not anticipating a major slowdown. What we are seeing is that manufacturing globally is weak and is probably weakening even further, but it doesn't seem to be big enough and bad enough in the U.S. to really trigger a lot of layoffs that would really hurt the household sector in a bad way. That could start to happen in December, January, and February, but I don't see enough evidence yet for me to say that that is definitely going to happen. I do talk about it in different things that I talk about and write about where it's a risk factor, but so far it's a small risk factor, and as soon as more evidence starts to get behind it, then of course I'll feel differently about it. But for now, it's a risk, but not a big one. Slide number 5, when we look at the consumer survey responses about confidence again, and you look at this diffusion index for confident and very confident, you can see the same thing, that the mood has topped out, and we're starting to see, more of a moderately positive view from the household sector. The consumer mood is still somewhat positive, but the best moments for that move are now behind us. It doesn't necessarily mean that we go through what happened in 2007 and 2008. The big difference there was such a malfunction in the construction economy, and so many jobs were being destroyed in construction in 2007. And then, of course, the credit system started to malfunction right after that. You put it all together, and you got a real big macroeconomic and credit problem. And you don't have that this time. In this case, the policymakers seem to have figured out, don't mess around with construction, housing, and real estate. Even if it's too expensive, don't ruin it. And it's one of the reasons why they don't touch the Fed funds rate. They're kind of waiting for the economy to just slow itself down so that they don't have to raise Fed funds rates. And a big reason why is they know that if they start to mess with that, then the construction economy starts to slow and the real estate economy starts to, weaken a little bit, and you wind up with some real estate prices start to go in reverse, and that results in some losses. And then the stock market starts to join in, and then you've got a little bit of stock market decline, along with some unemployment, and along with the real estate story. And they learned from 2006, 2007, 2008, don't let all of those happen at the same time. Big reason why they don't touch the Fed funds rate. And they're just letting the thing slow down on its own. And then, of course, they don't have to raise because they can just say, well, the economy's too slow right now, and the risk of it slowing down is too large for us to consider raising the Fed funds rate at this time. Now, the other thing is that the stock market has also gone through its best momentum, and that's the other thing that the policymakers see in the background, that the stock market has already peaked in terms of how much more appreciation stock prices can achieve. And if you take a look at slide number 7, you see 3 big cycles in our modern multi-decade, recent history, going back to 1980. And the method there is using a little bit of a technical signal to get what we call momentum. And what you do is you take one moving average that's like a fast moving average, and then you subtract it from a slower moving average, and that equals a form of momentum. And it works very effectively, and we've looked at it in our company, and we've back tested it, and it's profitable, and it's effective, and it does work. So what you see is the big hump in the middle there. That's your whole momentum going into the Asian currency crisis, 1996, 97. Then there's the big 1998 thing where there were some problems with Russia and Russia's debt and long-term capital management, and a little bit of a dip, and then a little bit more momentum, last push, strong dollar, big consumer market, all of the IPOs and the internet stocks, and then all of a sudden stock prices start coming back down. And they went down a long way, and then they continued to go down. When you go below the zero break-even line here, that's when the losses are really piling up. If you take a look at how high things were to how low things got, that's pretty bad. So it was destruction over a long period of time. And then you had a fast rebound starting in late 2003, and then an enormous plunge when credit stopped functioning in 2008. And then the enormous buildup after that, which has been propelled by quantitative easing, which is basically the Federal Reserve Central Bank buying Treasury debt to literally fund the country. Is basically just funding itself. Some people call it a Ponzi scheme. Some people call it monetization. There's a lot of criticism of it. One of the byproducts is price deflation. It's an artificial form of demand. And that, unfortunately, is how the world works now. I don't agree with it personally. Many don't agree with it personally and professionally. But unfortunately, it has become the way things are. In Europe, they do it extensively. Japan, on a smaller scale, has been doing it for decades. And then, of course, we've joined in, and now we stopped doing the quantitative easing, but it could start up at any time. And it has changed the business cycle. It's a major reason why real estate is so stunningly expensive, and then that leads to the big story in today's presentation about the migrations. People on the move, fleeing unaffordable areas. You see it in places like New York, San Francisco, West Coast, areas where it's turning into places where there's a fascinating environment of super rich and lower middle income. And the lower middle income piece of the story is not fun. So on the far right on slide number 7, you see once again the evidence that the cycle has peaked and stock prices are not going to really climb higher. Once that momentum has peaked like this, it doesn't go higher. And even with quantitative easing, and a continuation of 0% federal funds rates, it's very unlikely that stock prices would go higher once again, comparable to what we saw in these big rallies. So with that being in the background, the policymakers are taking note of that, and they don't want that to occur along with a real estate problem as well. Let's take a deeper look at, this central bank and government policy thinking and the story inside of wealth. And we've seen this table before, so let's look at it again. I just updated it for the latest food stamp program data. You got about 123 million households in the United States. About 59 million households make $50,000 a year and less. And that's about 48% of the grand total of all households as of the 2013 census. Out of that, you got about 42 million households make $35,000 a year and less. And then, of course, we all know that that's a disaster. That's about 34% of all households. So the $50,000 a year and less, we would call that a cohort. It's a statistical group. The $35,000 a year and less group, that's another group, that's a cohort. And what you do is you divide the 35K cohort into the 50K cohort, and that tells us how much of the 50,000 and less is represented by that 35,000 and less group, and it's 72%. Almost 3/4 makes 35,000 a year and less. The poverty in the country is enormous. We've talked about it before, and it has not gotten better. At this point, I think it's fair to say that policymakers are done trying to fix it the old-fashioned way, and now they just throw many different types of federally and state-subsidized programs and benefits in order to prevent it from breaking down. And if it were, then of course we would see something really disastrous, and the economy would slow down in a way that nobody wants to see. Out of this group, there's about 22 million households that are participants in the food stamp program, or the SNAP, that's the Supplemental Nutrition Assistance Program. That's about 18% of all households. However, it's about 53%, or more than half, of all of those that are in the 35,000 and less cohort. Once you get into that 35,000 and less cohort, things demographically become very, very difficult. There's a huge percentage in there that's single female moms with kids, and while yes, it does trigger eligibility for different forms of support, it ain't fun. And getting out of that cycle is very, very difficult. Not a pretty picture. Now, let's take a look at the inheritance and wealth transference backdrop to some of that. So now we understand that, not a pretty picture, and it continues. Slide number 10. The percent of households that have ever received an inheritance. The bottom half of the U.S. population, only about 12% of them have ever received an inheritance. In the top 5%, about half of all of those have received an inheritance. The bottom half of the population, only about 12% have ever received an inheritance. And on slide number 11, now we see the rest of the story. Among those, the bottom 50%, which is the orange piece of the pie, when they do receive an inheritance, the average inheritance is about $68,000. That's only, people, we're talking about 12% of the population. For the top 5% of the population, the average inheritance is about $1.1 million. So if you're in the bottom half of the country, the wage story is very difficult, and the inheritance story is also very difficult. Consumer funding, so what this means, to summarize some of that on slide number 12, the poverty is so gigantic that without federal and state intervention, let's not kid around, household spending would collapse. Let's really just come out and say it. It would collapse. So the impact upon global trade and the whole domestic service economy, the whole thing would be just a disaster. It would be very negative. So what's happened is that all global resources, tax rates, tax deductions, everything is put together in order to fund the U.S. household system, especially when there's the risk that poverty is going to get worse. everybody on the planet that has any power for policy making, the big corporations in every different industry, healthcare, pharmaceuticals, energy, IT, they all coordinate on this with governments and central banks. This is something that they don't stop holding together. They hold it together. And now you can understand on slide number 13, that's why U.S. corporate tax rates are so unusually high. Yes, there are loopholes that function along the way for many bigger corporations. However, you got to get as much juice out of U.S. corporations as possible. So U.S. corporate tax rates are shockingly high, partly because we have to do everything we can in order to hold together that U.S. household sector. So while, yes, there are different kinds of international location methods that can reduce exposure to the high corporate tax rate, whatever is exposed to taxes occurs within that very high tax rate, helping to pay for the subsidies. It's the nature of the beast. In the background as well, on slide number 14, the average wage growth in the private sector, average hourly wages, still growing only about 2%. That's the average growth rate, 2.1%, since January of 2009. It has basically stopped. And of course, if you have corporate tax rates that high, it gets very difficult to ask employers to pay higher wages. It just doesn't fit together. The grand bargain theoretically would be, let's lower corporate taxes and raise, the minimum wage nationally. That would be possible, but it's no longer the way things function. Another view of the wage story on slide number 15, the Employment Cost Index, which is a quarterly survey. Private sector unadjusted, and even though there's a little bit of a rebound from some terribly low year-over-year growth rates, there's still an enormous gap from this longer-term average and where we used to be, which is that reddish orange dotted line, the big one up there. That's about 3.35% was the longer-term average going way back. Now, again, same thing, a little more than 2% is the average annual growth rate for private sector wages. So after you see all that and you realize that the whole structure is subsidized and held together with many different types of efforts, quantitative easing, interest rates, prevent real estate from falling apart, making sure that the poverty story in the household sector gets as many different forms of support as possible. Retail sales don't really break down that much. They are weakening, and on slide number 17, you can see over there on the far right, over time, the growth rate, when I kind of normalize it and smooth it out a little bit, it's slowing down a little bit compared to some trends that we would see in previous cycles. And some of what we're seeing this time is just the nasty effect from price deflation. The price points are just relentlessly low or coming down continuously. That's a big piece of the story in the background, slide number 17. And that big dip over there, again, so much of what caused that to occur in 2009 was the credit malfunction and the stunning destruction of construction employment. If you had a different thing where the bank-to-bank contagion from mortgage banking problems wasn't as bad, and then the credit system stopped malfunctioning, you would have had a much more moderate downturn compared to what happened. And then, of course, we live in another world since that time. Slide number 18, we have a pretty robust holiday sales forecast for the 3-month period, October, November, and December. We kind of changed the model. We used to always do it November, December, and January, but I've noticed that October has gotten more substantial and January has become less substantial. And it's really tilted deeper into October, and November is a big month also. So for the 3-month period, I'm looking at about $980 billion, an increase year over year of about 4.2%. Last year, the growth rate for that same measurement was about 4.8%. And we're looking at core merchandise only. We're taking out automobiles, and we're also taking out gasoline stations, where about 66% of gasoline station revenue comes from gasoline. Then we add back about $20 billion from home improvement for seasonal goods, and you come up with some of the estimate here. So it's still a strong forecast. It's amazing how resilient it is, and it's partly because of the subsidies and the support systems that are in place. And employment is pretty decent. The wages may not be that good, but people are working. And again, we have not seen any kind of an uptick in requests for unemployment insurance benefits. That's the real key leading indicator in the business, is that when you see that start to creep up, and it could creep up, starting in November and then very much so in December. If that happens, then the whole thing slows down, and then we would have more difficulty achieving 4.2% year over year. Price incentives, going to be big, going to be pervasive. That's a given. We all know that. One of the big things, eating out, entertainment, going out, that's big. That's become bigger. Millennials especially, younger people, that is a very big focus of behavior and spending, is to get out, go places, be with their friends. Very, very big objective. A little bit of a weather risk, warm weather risk for the middle Atlantic, Northeast, always a threat in October and November. Even if you start to get little cold spells in October, big population areas in the Northeast, you've got to get a more extensive and prolonged period of cold weather in late October. It really has to kick in, and it has to stay there for weeks, really for 3 to 4 weeks in a row, in order for it to really hold together some of the better capabilities of the soft goods, apparel, seasonal side of the holiday season. The erratic weather thing, it doesn't work. You can't have one cold week or 3 to 4 days of cold weather, and then it warms up again, and then you get 2 days where it's a little chillier, and then it warms up. It won't support the seasonal soft lines story as much as could be the case. The weather forecast for the winter, and this is caused by the El Nino phenomenon, the southern half of the country starting in December will be colder than normal for December, then especially in January, February, and March, everywhere from New Mexico, especially in Texas and Louisiana, Arkansas, stretching all the way across the southeast into Virginia. All of this area will be a little bit colder than normal through March and maybe even into April. So slide number 19, change gears slightly here to look at what's driving the big story, the migrations, and its data plans. So in slide number 20, you can see that if we go from 2009, spending on connectivity was about $153 billion in a year, and that is increasing according to the telecommunications industry projections. That'll increase to $263 billion in 2017, which is right around the corner. So with these kinds of annual spending growth rates, just take a look over there on the far right side of the table, 8.7%, 7.9%, 7.5%, 6.4%, and now overlay that to what we saw in the wage story, and there's the problem. So it's either goods have to come down in price, which they do, in order to hold together spending, but this is an enormous burden, and it doesn't go away. So one of the things that it does, it changes how people really think about life in the big picture. So all of a sudden, people can leave places that are expensive. They can get out, and it may take time to do that. And all of a sudden, you're getting a lot of population migration, and that's an enormous impact on everything. So the focus for the household sector is to really stay focused on fixed costs. That is, spending on connectivity is a fixed cost. Long-term debt from the student loans is a big mental issue. Flat wage growth, big mental problem. And then, of course, people, have been brainwashed out of saving and being thrifty. That, has been beaten out of, people's brains for a very, very long time. The emphasis on household capital goods like a lawnmower, that also is shifting away, and the emphasis is on, yes, I might own my townhouse condo or my house that's in a planned community, but I don't want to really take care of the property like this traditional single-family home thing where people have to own all of their own equipment in addition to replacing all of the HVAC equipment from time to time. They're trying to get some of these things down, reduce the variable expenses associated with the cost of owning a house, reduce that, and really stay focused on mobility and connectivity. So one of the things that's happened, slide number 22, home ownership rate has come way, way down from where it used to be. According to our measures, it's way below record levels, and we believe that it's headed to 50%, maybe 52% at its lowest, but definitely heading to about 50% by mid-2016. Slide number 23, we see that renter occupancy continues to surge higher and higher, and a lot of this occurs in migrations of younger people into multifamily locations first, as they think about where they're going to move to, whether it's a condo permanently or some sort of a single family equivalent residency with ownership afterwards. But the big move is towards multifamily and renting, and that continues to fuel construction of multifamily and apartments. Some of the vacancy rates are, going up a little bit from time to time in different markets because of the vast construction of multifamily in so many markets. But over time, that stuff will probably get absorbed pretty successfully. So it's an enormous generational change in how people think about money, home ownership, mobility, really big, big changes. Then, when we started the conversation in the slideshow here, you see that the monetary policy encourages real estate bubbles, and now we see that bubbles encourage migration. So you go from policy and poverty to bubbles, and then you go from bubbles to migrations. And, if you want to start singing, if you know how to read that music, join right in. So one of the places that people are leaving, not in the biggest way, California, but they are leaving. Some are staying, but some are leaving. And all they have to do is look at the differences in the rents, and you can see where they can go. So they can go from California, where the average rent is about $2,000 a month, and they can go to Idaho, where it's about $800 a month, and the differential is about $1,200 a month. Wow. Or where they can go to Utah or Nevada or Oregon or Arizona. In any case, they are able to move to other mountain states in the West, and those are big destinations for migrations out of very expensive California. The United Van Lines, they do every year a moving migration kind of study of where are the areas that people are leaving from the most, and then where are they headed to the most. Yellow states, they're leaving the most. Blue states, they are headed to the most. Real clear. Leaving the Northeast, they're leaving big areas of the Rust Belt, and they are headed to, very typical destinations. The Carolinas, very big. Florida, continuously and always big. Texas, big. Oklahoma, phenomenally affordable. People are nice, and people are starting to move there more continuously. Very affordable. Make sure that you put some money aside for the tornado shelter. Just giving you a heads up, okay? Colorado, very attractive. Nevada, Idaho, Portland, Oregon metro area, of course, very attractive. But these are the areas that they're leaving. Northeast, phenomenally unaffordable on so many different levels. So in a place like West Virginia, the decimation of the coal industry is just causing people to leave for an easier lifestyle where they can make plans for the future, where they can really settle down a little bit better. Ohio has a multitude of different issues. Illinois has many, many different problems, and migrations out of Illinois continue. The Midwest, generally speaking, there's a lot of different problems, especially Kansas, Missouri, Illinois, Indiana, a lot of different issues. And then you can extend that grouping into Ohio and Michigan. So your biggest outbound states, New Jersey at the top of the list, New York, Illinois right after that, and then North Dakota because of the energy industry meltdown, West Virginia because of the energy and the coal especially, Ohio partly for those reasons, and then for many other reasons, Kansas just pure economics and a little bit. There's been a lot of issues in Kansas, generally speaking, for a long time. New Mexico, Pennsylvania, Connecticut, and they're all moving to Oregon, South Carolina, North Carolina, Vermont, Florida. Florida, of course, you get a combination of people moving there just when they're younger, and then, of course, you have retirees, and you're seeing that effect also in the case of South Carolina, where the retirees are moving to the coastal areas of South Carolina. Texas, Oklahoma, Idaho round out the story. Migration's an enormous factor in any discussion of how the consumer thinks today. And if you don't really include that in your thinking, when we come back to this kind of stuff in 10, 12 years, the demographic shift is going to be enormous, and the consumer markets where there will be density and focus on consumer markets in big numbers, they're going to be very different than they are today. There's going to be so many consumers in markets in Oklahoma and in South Carolina. It's really going to be a very different story. And the demographic mix is going to be phenomenally different. In some areas of South Carolina, people will talk like me. A lot of people will talk like me. That's the end of the way they used to talk. We will take care of that. Oklahoma, they're finished. That we will change how they talk. Although in the case of Oklahoma, the migrations are coming from multiple other places. The New York metro area migrations are occurring more primarily to Florida and to the Carolinas. Looking at the real estate bubble a little bit further, the migrations are being encouraged by the bubbles, and then the real estate bubble is a global phenomenon, and it resonates right out of China and Asia. Asian wealth investors think about real estate primarily, and in the United States, typically the way people have been kind of encouraged or brainwashed into thinking about wealth was through the stock market. Certainly, thrift and saving every penny has been kind of beaten out of people, and then it's been kind of encouraged, to get everybody into the stock market. In Asia, from the Middle East all the way through Southern Asia, in Russia, and then especially in China, the thinking has always been emphatically real estate. Own property and develop it, build something on it and own it. And that has led to the biggest real estate bubble in the world, which is Hong Kong. And then directly from there, China wealth investors have focused on Vancouver, British Columbia, second most expensive city on the planet, phenomenally luxurious and expensive. They go after coastal places like that. Also, coastal cities in Australia and New Zealand have been big targets, and then coastal West Coast USA, San Francisco, Seattle, San Jose, the whole Bay Area, phenomenally expensive, and you're getting some migrations out of those areas. So this drives phenomenal increases in real estate wealth in the West Coast and in some other major cities in the United States, Miami, New York being a couple of others. And then that in turn creates residual wealth that's reinvested back into more real estate, and then people are able to migrate because of connectivity, and they leave the unaffordable places, but the real estate investment bubble is able to build new opportunities for people to move into these less expensive markets like the Carolinas or different parts of Florida. The international client in the real estate market in the United States, you can see that there's two different types. One will be a resident, an international client who's already a resident of the United States, but slightly bigger than that is the non-resident, and that's the influence of Asian wealth diversifying out of commodities, diversifying out of stock market, and the problems over in China with the stock market there, they don't wait around for that to work itself out. They get out fast and they stay focused on real estate. That's the primary wealth objective of the Asian wealthy family, is always real estate, stock market secondarily. Own businesses, own real estate, develop it, build something on it, and you can see that in the USA. The dominant areas of origin for the international clients, Asia, and then of course, you know, the extensive Asian region where the wealth has just resonated all over the place into Australia, New Zealand, Hong Kong, Japan, not only China, and then Europe, Russia, and then of course Latin America. There's a lot of wealth, and they diversify out of different things there, and real estate's a big focus. Part of that is explained by what you see in Miami. Very, very wealthy, very successful, and very glamorous. And then Canada is partly fueled by the appreciation in real estate prices there that has created residual wealth, and then they are diversifying out of Canada right back into the United States. Labor markets in the U.S. Let's change direction for a second here. We can stop for a second, Justin and Ken, and see if there are questions. Would be good to breathe for a minute and see if anybody wants to ask a question now.
I don't know. Yeah, I have no questions on my end either.
All right, then we'll continue. We can see that in the manufacturing sector on slide number 33, manufacturing sector hiring difficulty shows that the market is quite tight. It's hard to get the right people. It's not even the cost of, you know, getting them on board. That's a little bit of an issue, but the biggest problem is just population, age, how many people have started to age out, or they just don't have the skills. Manufacturing sector hiring difficulty is, you know, difficult. Labor market there is tight, so the demand for people has been good, but now you're going to see that it's going to start to weaken. Service sector, same thing. Big demand, tight market. Some of this varies in demand for skills, unlike the manufacturing sector where the skill mix is a bit of a problem for hiring. Service sector, it's not as bad. It's a tight labor market. Again, we don't see any uptick in claims for unemployment insurance benefits, and that is directly reflected in this type of a survey here. And when you see that kind of a strong number, that means that the labor markets are tight, and we're probably at the peak for maximum employment based on this crazy mix of a job story, the way the economy is now structured. And when we go to slide 35, we do see a couple of service sector cycles in here. The first one on the left is, you know, 2005, 2006, 2007, and then things break down after the construction and real estate system starts to fall apart, and it really did fall apart badly and pulled the service side down with it. And then things start to rebound a little bit. This is a survey of expectations. So you pick up your peak in a cycle very nicely. And on the far right side, we can see this reasonably uptick in expectations, 2013, 2014. And my interpretation of what I'm seeing in 2015 is that we've maxed out in expectations for demand for more hiring in the service sector. So I think the cycle has kind of maxed out, consistent with what we saw in the stock market measurements in the show and in the other observations that suggested that we've kind of peaked out and things are slowing down a little bit. And of course, that's why the Fed funds will probably stay at zero. Let's take all of that and now put it into the framework of the rest of the planet and see where does the U.S. household sector story fit in with the rest of the planet. Deflation, price deflation, because of the central bank monetization, quantitative easing stuff, it really causes a lot of deflation. So that is now widespread, huge problem, and their answer to it is just more quantitative easing. Unfortunately, that's the way it is. Population growth is scary, and then global displacement, which you see in Africa and the Middle East, all the way across a vast area of the planet, from Afghanistan all the way back to the west coast of Africa. I mean, people are on the move in a way that has not been seen. It really, in a way, surpasses, in a way, much of what occurred in World War II. This is on an absolutely gigantic geographic scale. So this could turn out to be the single biggest story in 2016. We don't know how it's going to play out because it's an enormous social experiment. And let's take a look at a little bit more of this. This is a big deal. We need to think about this. And for those of you who make consumer goods, this is your business, because the experiment is this. Can governments bring in more population in a peaceful way, reasonably peaceful? And if yes, then gradually over time, these become your new consumers, and then your consumer market gets bigger. That's the experiment. All the policymakers and the big companies around the planet, that's what they're trying to achieve. Okay, on the surface, it's like humanitarian, but right behind that is the same thing that makes the world go round from, the last, let's say the last 8,000 years, and it's money. So you tell somebody who makes, jeans that you're going to have 2 million more people available in the EU, and they're going to wear out their jeans. It's like, we need them. Get them in there. So anyway, slide number 37, the UN, in their discussion about forced displacements, global trends, late 2014, they are saying that there's about 59.5 million individuals who were forcibly displaced worldwide. By now, it's even more. That's 8.3 million persons more than the year before, highest annual increase in a single year. Now, statistically, that's 18.5% of the U.S. population as of May 2015. That's big. That's enormous. Now, if millions of displaced people can be absorbed peacefully into the EU and into North America, the big experiment that we're talking about here, then the consumer markets, they're going to be bigger, and global growth could expand. And when you have price deflation, well, the only answer to that is to increase volume. There it is. Consumer goods, medicines, services, everything can increase if you can take that displacement phenomenon and peacefully transition it into people who will now be a part of the system. It's an experiment. No historical guideline exists for this. This is really different than World War II. As this continues, it should help to also reduce poverty, which has recently been indicated to be below 10% for the planet in the most recent measurement from the World Bank in a paper that they just released. It's a big, a big PDF, and I didn't read the whole thing, but I got the gist of it. Ending extreme poverty and sharing prosperity as of October 2015. It just came out a week ago. So the global poverty rates, they're falling and the objective for policymakers is to combine the capability of those systems to bring in more people. And ironically, if you get them out of these really discombobulated and self-destructive places in the Middle East and Africa, then they wind up in places that are more stable, and then poverty goes down. So if statistically you're taking 60, 65 million people out of impoverished, war-infested places, then there's less people in those places. And then if you put them into places that have a lot of policy subsidies, then the measures of poverty actually are forced down partially through that experiment. It's very interesting, but that's what's happening. Strange story. Meanwhile, in the background, the global contraction in wealth continues. This is the big story impacting stock markets, global growth, and policy. So if we look at world reserves in U.S. dollars, those are residual forms of wealth that are accumulated as trade proliferates, and the U.S. dollar winds up being accumulated over time, especially in emerging markets and by big commodity exporting countries, especially when it comes to crude oil. So when crude oil prices go up, when energy, petroleum product and crude oil prices go up, residual wealth around the planet actually goes up. Yeah, it gets expensive for the U.S. driver back in 2007, 2008, we saw that, but it creates residual wealth somewhere else. What we're seeing now is a stunning and dangerous reversal to that. The cumulative increase in world reserves in dollars has been about $1.5 trillion between 2011 and 2014 when oil prices started to decline. The decline in world reserves since that time, since June of 2014, when we reached our peak of about $11.5 trillion in world reserves in U.S. dollars, we've contracted by more than $600 billion in just a year. Stunning. That's 41% of what was built up over 4 years. Again, we have wiped out 41%. It's getting towards half of what was built up over a 4-year period has been blown away in just a year. That's a no-no. That is part of why confidence is starting to decline, and the Fed is very wary about touching the Fed funds rate, and that's why you're seeing China weakening the way it is, global trade slowing a little bit. Nothing really catastrophic has happened yet, but this is big. This is an enormous reversal in the planet's wealth generation system. And what's one of the results that we already see when you get stuff like that? You'll usually see a big increase in conflict, and now you see it spiking up dramatically in the Middle East, which of course had plenty of conflict before, but now you see more direct conflict with Russia, which is very exposed to this problem because about half of the country's revenues are sensitive to commodity exports, and you see that the fundamental conflict between Saudi Arabia, Kuwait, and Saudi Arabia's other friends, and Russia, not friends. It's not a friendly relationship. You see that Russia has more of an alignment with Iran, and definitely not the case with Saudi Arabia. So Saudi Arabia is now attempting to sell crude oil that they produce directly into the EU, into markets where Russia was the export source before. Syria becomes the battleground for more outright military conflict, and the game just takes its own form and grows on itself. And that kind of concludes our observation about the state of the U.S. household sector, consumer spending, and the U.S. holiday season outlook. So we've been able to make a connection between the state of the consumer and the wealth and poverty problems here, and migrations and movement and real estate, and a global connection between all these things, and then connect it back to this bigger picture of deflation, commodity price deflation, and what's visibly occurring, right in front of the screens in front of us, the increased amount of military conflict on the planet. So I'm going to stop there and take all of the questions that you might have. So Ken and Justin, I'm going to turn it over to you.
Nothing from the room here.
But, however, hello room.
Hi, Reg. Hello.
Hi, guys. Justin,
Right. Yeah, we have a couple questions here from online. The first question is, what would be the impact to the U.S. if China starts to strictly enforce the U.S. dollar currency flight restrictions on its citizens?
I don't know. I don't know. I don't know what kind of controls they might really enforce. I really don't know. Excellent question. I apologize. I just don't have a good answer. I don't know.
Okay. The next question we have is, what are the countries with the highest decline in hard currency reserve?
Oh, they're led by China, Russia. So it's really the big oil export nations, the big commodity trading nations, the ones that have big volume. The data that I have, I don't have it open right in front of me. The biggest, Saudi Arabia, China the biggest, Russia big. But ironically, what's happened in Russia is that the currency weakened so much that it actually facilitated their export business. And then the currency translation from the ruble back into the dollar domestically inside of Russia has kind of functioned, and their reserves haven't crashed the way they've been going in Saudi Arabia. It's been much worse in Saudi Arabia. And the thing about the oil export giants like that, they have no diversification in their economy. They have no agriculture. Kuwait, Saudi Arabia, really difficult. There's nothing else there. So the outlook for reserves associated with commodity price deflation, it's pretty ugly. Saudi Arabia faces a bigger, longer-term problem here than perhaps Russia does, because Russia's economy is a bit more diversified. They do have other types of commodities that they can play with, and they manufacture other kinds of things. Saudi Arabia is very limited. Kuwait also. But those are the three that came to mind. Those are the three biggies. I just don't have the details right in front of me, and I don't want to start trying to open up files and find it, and it would just make a mess on the screen. But if you want more details, I'll be happy to share what I have from the latest summaries that I generated from a few months ago. Just get back to me through the guys at the Federation, and or directly to me, and I can share what I know.
Okay, great. The next question we have is, what would you say are the 2 to 3 most important things that we could, or trends that we could look for going into the holiday season?
The trends would be millennials and entertainment, which is a less understood behavioral trend, how important it is for them to spend money on entertainment and going out. I don't think there's sufficient measurement of that, and I don't think it's really carved out sufficiently in our understanding of the holiday season. After that, I don't really do any fashion forecasting anymore, so I don't know what types of colors and fabrics and styles would trend better this year compared to another. I just am no longer close to that subject. I do know a little bit more about the millennials' behavior. The next thing after that is, it's been a big theme, and it's gotten even bigger, and there's a cross-reference between the going out and entertaining and eating out and kitchen. And all you got to do is go to the stores, and it's overwhelming. The spending on kitchen and cooking-related stuff is extraordinary. So that's very big. Any retailer that has a good exposure to that and has a good marketing framework already built up to support that, whether it's Crate and Barrel, Pottery Barn Williams-Sonoma, which is all one company. You know, the fun thing about Macy's kitchen section is you go down to the Macy's kitchen department and you start, you know, looking at prices on something. Let me tell you, they keep the adventure in price in a way that no other retailer can do. You go up to the cashier and ask them to check the price. I'm telling you, it's always going to be different and lower than what was displayed, and then ask them, are there any other coupons or family and friends discounts? And they're going to start pulling out those pieces of paper, and they'll scan them also. So they're deadly. Don't let, you know, Macy's, you go down there, and they are rough. They are very competitive when it comes to that stuff. Oh, man. But the kitchen, cooking, gourmet food phenomenon has grown. I don't have any statistics on it now because I don't get that granular in the consumer shopping behavior like I used to do years ago, but it's big. Those are two or three themes that appear to be pretty big. After that, I would say the next one would be for people to do some remodeling, and that is partly to support the value of their real estate so that they can stay connected to the bullish real estate cycle all over the country. It's everywhere, especially like down here in Charlotte, North Carolina, where I am. It's really caught on. And what's happening is that in markets like this, South Carolina will go through the same thing. The prices for real estate, they keep creeping up. Taxes are relatively lower. And then because the prospects for more people moving in keep going up, the prices for real estate, they're creeping up in other markets. So everybody's into it. So it's all connected. And those are a few themes that'll kind of be bigger than maybe expected for the holiday season.
Hey, Rich, have you seen any statistics on the percentage of Christmas sales that are going to be made via the internet?
No, I don't know that one either. That's a stat that I no longer track, so I don't know, Ken. And then, of course, it's a blurry kind of number because everybody has a direct or indirect access to selling something through a non-store channel. I don't know.
Okay.
It's you know, with Amazon Prime being what it is now, it's, I think it might even be difficult. There's probably some good stats out there, but I don't know what they are.
All right, we have one more question here. The question is, why is QE credited for deflation as printing money is generally inflationary?
Well, when you increase the amount of money that's available to create debt, and it's usually associated in the modern form of quantitative easing and central bank intervention in the case of Japan, the ECB, and the Federal Reserve, it boosts the amount of debt that is both issued and the amount of debt that ultimately has to be retired, and then more money needs to be available in currency form to ultimately be there for when debt is retired and recirculated. It boosts the value of debt over time, not on the interest rate side, but on the price of the debt itself. It increases the amount of debt that gets issued, and it increases the volume of the debt and the price of the debt itself in the traded market and in the secondary markets. And the classical model for this type of deflation is prices for other kinds of goods and services will go down as the value of debt goes up. So debt winds up eating up more and more wealth, and then it kind of feeds on itself. In the old model of printing money, let's say Weimar Germany, 1920s, that kind of outbreak of hyperinflation was associated with a breakdown in trade, a breakdown in the credit system where there's insufficient credit available and where credit and trade are really broken. And then in that case, they started having to print money like crazy and went through the classical shopping cart filled with, you know, a bunch of bundles of money all tied together with twine and strings and things like that. Instead, in this case, it's a society where more and more money gets absorbed by debt, and in an ironic twist, it winds up creating an artificial form of demand that does not boost prices. It actually pushes them down for consumer goods and for services. So it's very different from the older models of credit and monetary events from many, many decades ago. The modern quantitative easing stuff is typically deflationary, very associated with excessive amounts of debt, debt gobbling up wealth, debt requiring more money printing for debt, and an enormous amount of money through artificial demand, like all that subsidized stuff like the food stamps. Then there it is. Now you're basically creating an artificial form of demand that in turn suppresses prices. At the same time, the modern world's ability to create more stuff in volume easily is just a runaway problem unto itself. So there's a thing that I call the optimization bubble. And the optimization bubble is a global phenomenon wherein software, global marketplace software, and analytics of every single thing in every phase of production, it's creeping into human behavior quite a bit as well. People are becoming more robotic. They're less human in their interactions with each other. But it's the optimization phenomenon where everything gets taken apart and optimized, and then it's possible to make more and more and more stuff. And then there's an idea that if you can increase volume, then it'll offset the price declines that are associated with these periodic weak troughs in demand, like in 2008 and 2009, 2010. So demand weakens a little bit, and then optimization just kicks in, and everyone starts lowering prices and making more stuff. So at this point, it's a runaway problem, and everything is designed to optimize everything. So the value of goods, price points have gone down, and then the value of debt, real estate reflects this perfectly, the value of debt has gone up. Just imagine what it is to buy an ordinary residence today, let's say $350,000. When my mom and dad bought the house in Nassau County in 1969, they paid $29,500. We all know these stories, but that's what's happened. The value of debt has gone up relentlessly, and it's gotten much worse. And in turn, it's basically starving money away from consumer goods, and then the rest of it gets subsidized by monetization of debt, for example, quantitative easing, buying treasury debt in order to fund different kinds of federal programs, such as the 2009 American Recovery Act, and then many different programs after that, all of it sometimes requiring a good funding cycle for treasury debt. And then if the government sees that they need to support things further, they issue more treasury debt, and if it's too much for the secondary market, then the central banks kick in and they just start buying the debt outrightly. It's a deflationary force for slightly complicated reasons.
All right. It doesn't look like we have any more questions on our side. Ken, any more in the room?
Nope, none here.
And it's goodbye room. Hope to see you all again one day. And Ken and Justin, thanks to you all for having me. And thank all of you for being here today. And if I don't speak to any of you, I want you to have a very healthy and happy holiday season. Please do.
Thanks, you too. You too, Rich. Thanks. Take care.